So it says question 1, as per the bond has been issued with the face value of rupees 1000 at 10% coupon for 3 years. Coupon is the amount that is basically being paid to the investor at regular intervals over there, that forms an annuity. And further, it is said that the required rate of return is given to be 8%. What is the value of the bond? If the coupon amount is payable on half yearly basis, that we need to calculate the present value of the bond over there. So here is a concept so as to make you understand that we are having a bond over there which is having a maturity of 3 years, but the coupon is being paid half yearly. So there will be 6 half years in 3 years. So it will be something like that. Each half year that will be paid with the, you will be paid with the amount over there that would be related to what, that would be the coupon amount that will be paid to you. Just keep in mind that the coupon amount is paid on the face value. So in the question over here, we are provided that the face value is given to be 1000 and further the coupon is given to be at 10%. So whatsoever the coupon amount will be paid, it will be rupees 1000, it will be rupees 100. But over here you need to look into the factor that over here the coupon is being paid half yearly. So we will be having the coupon percentage to 5% and it will be only 50 rupees which will be paid for the 6 half years, which will be paid for the 6 half years, 50, 50 and 50 and 50 each and a half year. This amount will be paid. Okay, is that particular thing clear over here? Is that particular thing clear over here? That is 50 rupees will be paid for each and every half year over here. And further, we are required to calculate what? We need to calculate the present value. So let me just tell you that in the bond itself, you will be getting the coupon amount each and every period, and at the maturity itself, the person will be getting the par value or the face value. That is rupees 1000 also will be returned to the investor itself. So that is related to the inflows that are going to be there and will be calculating the present value. So what will be the formula? It will be equal to the PV IFA. Now basically if you look at this particular factor, this is the coupon amount that we will be receiving. It is forming an annuity. It is forming an annuity. So we will be just calculating the present value of interest factor of annuity, that is PV IFA, and that is to be calculated on the coupon amount itself. So coupon multiplied by the PV IFA, and further that is to be calculated on the required rate of return, that is KD percentage, and for the end terms plus face value, because we are going to receive the face value because at the very end. So it will be PVIF only, that is a present value interest factor only, and KD percentage again, and further N over here. So as I already told you that the coupon rate is mentioned to be 10% over here, but we'll be considering it to be 5% because the coupon is being paid half yearly. So it will be 10 divided by 2%, that is 5% over here. And what is the coupon amount being received at every period? It is rupees 50. It is received at rupees 50. So again PVIFA, and required rate of return is given to be 8%. It is also to be halved. So it is 4%. And how many periods are there? It is basically the 3 years maturity the bond is having, and half yearly. So it is basically 6. N is equal to 6 over here. Face value, that is 1000 over here. I'm just substituting the values over here. Then we'll be calculating the PVIF and PVIFA values. Okay. So again 4% and then 6. Now we need to calculate the value of PVIF and PVIFA. What is the methodology? We will be just adding 1 to the ROR, that is 4%. First of all, converting the required rate of return to the discount rate to the decimal value. So it is 0.04 plus adding 1 to it, and further it will be raised to power 6 that you need to calculate, divided by 1. So this is the factor that you need to calculate so as to calculate the PVIF value. So as to calculate the PVIF value. On the simple calculator, you can simply calculate it 1 divided by 1.04. And further, now you need to press the equal to sign for the same times it is raised to power. So it will be 1, 2, 3, 4, 5, 6. So it is a PVIF value. This particular value, it is basically 0.7903. Okay, multiplied by 1000 over here, and plus we now need to calculate the PVIFA. Simply press the GT button over here on the calculator. So if you do not have the calculator which is having the GT button, kindly please do replace your calculator before going to the exam. So it comes out to be 5.242, 50 multiplied by the same, and that is basically that you need to calculate, and that will be the answer. So 5.242 multiplied by 50, that comes out to be 262.10, 262.10 plus 790.3 plus 790.3, and that is answer, that is equal to 1052.40. Now how can you cross check if your answer is right or wrong? Because over here the required rate of return is lesser than that of the coupon rate. Over here, the required rate of return is lesser than that of the coupon rate. In that case, the present value of the bond exceeds the face value. So here is an inverse relationship between the interest rates and the bond prices over there. That is all already you know. So let me just tell you that if the required rate of return is lesser than that of the coupon rate, in that case the present value would be greater than that of the face value. And further, if the required rate of return is equal to the coupon rate, in that case the present value would be equal to what? It will be equal to the face value of the bond. And further, if the required rate of return is greater than that of the coupon rate, that if it was mentioned to be 12%, in that case your present value of the bond would be lesser than that of the face value. That is related to the conceptual part. Okay, so this is how you need to solve the questions related to the bonds over there. Next, it is related to the question that is a console bond of rupees 10,000 is issued at 6% and coupon current interest, it is mentioned to be at 9%, and we need to calculate the current value of the console bond over there. Now, what are console bond? Console bond is a bond over which you are getting the coupon for indefinite time period. That is, they are having no maturity. That is, a perpetual bond are also said to be what? Those are also said to be the console bond over there. But these console bonds are having a limitation that these are not redeemable. Okay, so if we need to calculate the current value of the console bond, that's quite easier. You just need to do one thing, that is let me just tell you, that is present value of the console bond is equal to the what? It is equal to the coupon amount. It is basically equal to what? It is equal to the face value of the bond divided by the coupon amount here that you are going to receive over there. Okay. Sorry, it will be equal to what? It will be equal to what? That is a coupon amount that you are receiving divided by the current interest rate. Divided by the current interest rate, that will be it. So coupon amount is where, but it is 6% that you are receiving. So it will be 6% of 10,000 divided by 9%. That is the current interest rate right now. So 6% of 10,000, that is equal to 600. And further, divided by 9%, that is 0.09. Converting it into decimal part. So it comes out to be 600 divided by 0.09. That is equal to the 666.66. So that is a present value of the console bond. Okay. Next question over here, it says the XYZ Limited has issued a 10 years 7% coupon bond. That is 10 years is a maturity, 7% is a coupon, and for the face value of the bond is given to rupees 1,000, and bond makes annual coupon payments. Against the question number 1 where we were getting the half yearly coupon payments, over here we are receiving the annual coupon payments, and further it is given that the required rate of return is 10%. Over here we need to calculate the bond price. So the same formula goes on, that is a present value of the bond over the coupon PV IFA that you need to calculate. Just keep in mind, because coupon forms a annuity. So in that particular case we need to calculate the PV IFA for KD percentage N over there, and for the face value we need to calculate the PV IF, that is a present value interest factor, and for the KD percentage and N over there I'm just substituting the values over there. What is the coupon amount that is being received? It is 7% of 1,000, or we can simply say it is a 70 rupees which is being received over there as a coupon. And for the PV IFA, the required rate of return percentage is given to be what? It is given to be 10%, and for the N is what? N is equal to 10. N is equal to 10 because the maturity over here is given to be 10 years, so it is 10, and face value is rupees 1,000. PVIF, this particular value that we need to calculate for 10% and 10 over there. So this is what we need to calculate, and I just told you that we need to calculate what? That is the required rate of return, that is 0.1. We will be just converting it, the required rate of return, into the decimal part, adding 1 to it, and further this term will be divided by 1 and raised to power the n, that is 10 over here. So that is what you need to calculate, that is 1 divided by 1.1 raised to power 10. Okay, so it will be 1 divided by 1.1, and we will be now pressing the equal to sign for the 10 times. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, and that comes out to be 0.3855. Okay, so that comes out to be 0.3855. I'm just writing this value over here. So it is 1000 multiplied by 0.38554, and further just simply pressing the GT button, that is a grand total. So 70 multiplied by 6.1445. Okay, so that would be the PVIF value that we are getting over here. So multiplied by 70 plus 385.54. That would be the answer, that is equal to 815.65. And I just told you that we can do cross check. So over here, the coupon rate is basically lesser than that of the required rate of return. It is lesser than that of the required rate of return. So it does imply what? That our present value would be lesser than that of the face value. Our present value would be lesser than that of the face value over here. So our answer is right over here as per the conceptual part. Okay. So that is related to question number 3 over here. Next question over here is related to the item over here. Over here it says, suppose you purchased a bond for rupees 1000 for rupees 920. So it means what? It means that the face value of the bond is given to be rupees 1000, and for the current market price for which we purchased, it is given to be rupees 920. Further, it is given that the interest is 10%, that is a coupon rate is mentioned to be 10% over here. And further, it will mature in 10 years. So N is given to be 10 over here. Okay. So we need to calculate the YTM over here. So here is a formula that you need to remember, that you can easily calculate the YTM over there. Otherwise, it's quite difficult. You need to apply the hit and trial method over there. So here is a formula that you need to use. That is a YTM is equal to what? It is equal to the coupon and plus F minus P. F is basically the face value and P is the present value. P over here is basically signifying the present value over here, divided by N, and further divided by the face value plus the present value divided by 2. So here is a formula that you need to memorize. I'm just substituting the value over here. So what is the coupon amount that is being received over here? That is 10% of 1000, that is equal to 100. So that is a coupon amount. Face value is 1000 over here. So 1000 minus the present value. Present value is basically the amount for which we purchased. That is the current market price. That is 920 over here. And further we are having N value equal to 10. That is equal to number of tenors over here for which we will be receiving the coupon. Okay. So that is basically 10 over here divided by face value again 1000 plus 920 divided by 2. You just keep in particular one thing in mind, that in the numerator we were having the N, but in the denominator we are having the 2 over here. That is what you need to calculate. Okay. So over here I'm just solving it out. So it comes out to be 100 plus 1000 minus 920, that is equal to 80, and further divided by 10. 80 divided by 10, that is equal to 8, and further 1000 plus 920, that is 1920 divided by 2. So it is 1920 divided by 2, that comes out to be 960 over here. So it is 108 divided by 960. So 108 divided by 960, that comes out to be 0.1125. Now converting it into the decimal part, that comes out to be 11.25%. That is the YTM. So that will be the answer over here. So the YTM over here is equal to 11.25% as per the information available. Okay. So that will be all related to this particular case study. It is given it the figure provides information about the quantity of money on OX axis. That is, on X axis we are having the quantity of money, and on Y axis we are having ROI, that is the rate of interest. MS is the money supply curve, and for the LP1 and LP2 are given to be the liquidity preferences curve. So as per the Keynesian theory, or as per the theory which was given by the J.M. Keynes itself, he provided for that there are different reasons why the money supply do differ. And further he added that the rate of interest do determine the demand and supply of the money in the economy itself. And further he believed that there are two types of the assets which are over there. One, it is related to the cash balances, and the other one, it is related to the long-term bonds. And as we are aware that the bond prices are inversely related to that of the interest rate. What does it indicate? That if the interest rates go up, the bond prices will come down. If the interest rates are lowered, the bond prices are higher enough. Okay. So he basically thought that he basically gave the theory related that the people, if they are having higher income, definitely they will be keeping the amount with themselves for the transactional purposes. And further, if the interest rates go higher, they will be basically investing the amount for higher interest earning, and will be keeping minimum to minimum amount in their hand. Okay, so that was related to, those were the assumptions related to the Keynesian theory. Now let's solve the questions. Over here it says, what are the LP1 and LP2? So LP1 and LP2 are the liquidity preference curves, and these are also said to be what? These are also said to be the demand curves over there. That for a particular money supply, if you just look at this dotted line over here, this is a money supply at some particular point. Okay, so now over here, related to the other conditions, that if the rate of interest does increase or is basically decreased, in that case the liquidity preference curve will change. Okay, so that is related to what? LP1 and LP2 are what? These are the demand curves or the liquidity preference curves. Let's move to the question number 2 over here, which says it is observed that there is a shift in money demand from LP1 to LP2. That is, I already told you that these are money demand curves, and further there is shift that previously it was LP1, now it is LP2. Why this shift is over there? So I just already told you that as per the JM Keynes, there are two factors. One, it is related to the nominal income. One, it is related to what? One, it is related to the nominal income. That is the earning. That is the current earning. So if we are having higher earning, we'll be keeping high value amount in our hand for the transactional motive. And for the second one, it is related to ROI. That if the rate of interests are increased, definitely you will be basically investing your amount in the bond itself, that is in the long term bonds. Okay, and further that will basically do what? That will basically reduce the money supply. That will basically not reduce the money supply, but that will basically reduce the demand of the money. Okay, demand of the money will be reduced if the rate of interest is higher. Okay, and further if the rate of interest is lowered, in that case the demand for money supply will increase, because people will not be basically investing their amounts, they will be just keeping the amounts with them. Okay, so that is basically related to the shift in the demand and supply from the LP1 to LP2. Okay, next question over here, it says if there is expectation related to what? Related that if in near future, if there will be increase in rate of interest, the demand for money or liquidity preference will increase, that the money demand will basically increase. I already told you that if there is a rise in future, in that case what will happen actually? There will be shift in liquidity preference, because there is increase in rate of interest now. And which of the following will not be correct in that particular regard? So first of all, let me tell you that if the rate of interest is increased, previously if I consider it was OR, now it will shift to OH first of all, and further related to that, previously if the demand was related to at equilibrium point E, now it will basically shift to what? It will shift towards point F over here. Now what will happen actually when there will be shift over there related to there is increase in the rate of interest? Let us take the case that previously it was 4% and now it is 6%. Now when it is increased and the money supply is fixed, in that particular case our equilibrium point will shift from point E to point F, and further our LP1 curve will move towards the LP2 curve. Okay, that is going to happen, and already our OR interest is now increased to OH interest. Okay, so that is all related to, and that we need to find out. Over here we will need to look at the different options over here, and we need to select which one is not correct. That would be our right answer. So it is given to be LP2 will move towards the LP1. But otherwise it's wrong over here, because LP1 will be moved towards LP2, not LP2 will move towards the LP1 over here, because the rate of interest have been increased, not decreased over there. So this particular statement is wrong, and that will be our right answer over here. So option A will be the right answer. Also look at the other options over here, that is LP1 will move towards LP2, right? The equilibrium point will be at point F, no, definitely right. Previously it was point at E, but now it will be at point F over there. And for the rate of interest will change from OR to OH. Okay, so that is also true. So that will be all related to this particular question and the case study over here. That a firm is having a capital of 200, reserves are given, term loans are provided, advances from customers, sundry creditors, bank CC limit, balances, and further related to the fixed assets, preliminary expenses, a debit balance in profit and loss account, advanced tax base. Each and every term is given over here, and first question says that we need to calculate the tangible net worth. Now what do you mean by net worth? First of all, so if we basically having a sum total of capital plus reserves, that is basically related to what? That is a net worth itself. And further, when we'll be subtracting the intangible assets from the net worth, that will basically give us what? That will give us the TNW, that is a tangible net worth. Okay, so over here we are providing the data related to, we are providing the capital, reserves. Capital is given to be 200, and also the reserves are given to be 230. So this is the net worth we have calculated, that is 430. So this is a net worth that we have calculated, that is given to be 430 over here. Now we need to find out it over here in the question if we are provided with the intangible assets. Now which assets are basically intangible assets? Like if we say we are having the preliminary expenses, those are intangible assets which cannot be basically felt, which cannot be touched, but those are having a material value. But those are having the material value over there. Why? Because those expenses were occurred and those are being benefited. Okay, so likewise we are having the preliminary expenses over here. We are having the preliminary expenses over here related to what? Related to rupees 80. So over here if we look at, we are having the preliminary expenses. So these are the intangible assets. These are the intangible assets amounting rupees 80 and further 80 crore for the debit balance of the profit and loss account. So if there is debit balance, what does it indicate? It indicates the loss, and also it's an asset. Loss is also asset for the company now. So it's what kind of asset? It is also an intangible asset. So I'm just writing it over here. So loss, that is a debit balance over there. So 30, that is also what? That is also your intangible asset over there. That is also your intangible asset over there. So those two assets are to be subtracted from the net worth over there so as to calculate the tangible net worth. Other than that, advance tax paid, that is a prepaid taxes, and further prepaid payments, those are all the current assets. And further these are the two components which are related to the intangible assets over here, amounting rupees 110 over here, and 430 minus 110, that will be 2 and 3, that is basically our tangible net worth. So tangible net worth we have calculated, I'm just writing it over here. Tangible net worth we calculated to be 320. Is that clear? So now let's move to the next question. Over here, which says, in the above problem, what will be the current ratio? Now, what is actually the current ratio? What is the formula for the current ratio? It is current assets divided by the current liabilities. Current ratio is equal to current assets divided by the current liabilities. Out of which would be the current assets and which would be the current liabilities, we need to look at it. Okay, so first of all, we are having the term loans. So term loan is basically long-term liability. I'm just writing it over here for the reference purposes. Just let me write it over here. So long-term liabilities over here, it is 180. Further, advances from customer, it is 10. Also a short-term liability. Sundry creditor, it is also what? It is also a current liability. Sundry creditor, it is given to be 100 over there. That is your current liability, CL. And for the bank CC limit, it is also a CL, that is amounting 400 crores. I'm just writing CC over here. And for the fixed assets are fixed assets type, and for the advanced tax, these are current assets. Advanced tax if paid, these are the current assets over there. And also cash in hand, CAIIB, this is also current asset amounting 20. Stock is also current asset, but it must not be older than 6 months, amounting 100. And further, it is further also given over here sundry creditor. It must be sundry debtor, because sundry creditor amount is already given over here. So we'll be considering, I'm just rectifying over here the question, in question over here, it must be sundry debtor. So sundry debtors are what? Sundry debtors are also the current assets. So I'm writing over here, that is sundry debtor. These are 300 crores. Okay, so these are the different components related to the current assets. So what is the sum total? The advanced taxes were amounting what? The advanced taxes were amounting 20. So 20 plus 20, 40 plus 100, 140 plus 300, that is equal to 440. So current assets are 440. And what is the amount related to the current liabilities? What were the different components we have just checked in current liabilities? And now we need to calculate the denominator part, that is related to the current liabilities over there. I already told you that whatsoever advance has been basically taken from the customers, or it is related to the sundry creditors or CC limit. All these three components are related to the current liabilities, which amount to 510. Which amount to 510 over here. So what would be related to? So what would be related to the current ratio of the firm itself? So it is, what would be the sum total related to the current ratio over here? As you can clearly see that the current assets are lesser than that of the current liabilities. What does it indicate? It indicates that the firm has to borrow the short-term funds so as to meet up its day-to-day obligations. Okay. So what would be the current ratio? It is 440 divided by 510. That is not acceptable at all. So over here, the current ratio comes out to be 0.86. It comes out to be 0.86 in this particular case, and that would be the answer. Now let's move to the next question. It says in the above problem, the total outside liability to tangible net worth ratio would be. What will be the total outside liabilities to the tangible net worth? The tangible net worth we have already calculated, that is the denominator part. So denominator part, tangible net worth we have already calculated, and we need to ascertain the outsiders liabilities. Outsider liability. Now what do you mean by outsider liability? That liability that is to be paid to the outsiders, like any of the term loans, any of the short term liability which we need to pay off. Okay, so that is all related with the outside liability. So over here if we consider whether it is related to the advances from the customers, sundry creditors, bank CC limit, these are all the outside liabilities, and also the term loan component. These all will be the outside liabilities. So long term liabilities 180 plus 10 plus 100 plus 400, that is equal to 510, plus 180, that is equal to 690. That is equal to 690. That is basically the component related to outside liability. Which different components? Long term liabilities plus the advances from the customers plus sundry creditors plus CC limit divided by the tangible net worth minus the intangible assets which we have already calculated. So long term liabilities are equal to 180, advances from customers it is 10, and further the sundry creditors are 100, and CC limit balance is 400 divided by the tangible net worth we calculated as 320 already. Okay, so that is basically equal to what? That is equal to the 510 plus 180, that is equal to 690 divided by 320. That would be the answer over here. So 690 divided by 320, that is equal to the 2.156. So that will be the answer over here. That will be the answer related to question number 3. Okay, now let's move further. Question number 4, it says if the sales are 2000, what will be the stock turnover ratio? What will be the stock turnover ratio? So stock turnover ratio helps us in a way so as to ascertain that how we are managing our stock and how many times the stock was replaced, and its formula is equal to what? It is formula is equal to the sales divided by the stocks. So what is the amount of the sales that is given to be in the question? 2000. And what is the average value of the stock that is given into the question? That is given in the question. Let us have a look at it. It is given to be 100. The stock value is over here is given to be 100. So what will be the stock turnover ratio? 2000 divided by 100, that is equal to 20. So that is basically the stock turnover ratio. Is that clear? Now let's move to the next question over here. It says if the sales are given to be 3000, the debt collection period would be what? And further, if we need to calculate the debt turnover ratio, what it would be? So debt collection period, so it must be higher or lower. It is basically the average period. It is the average period by in which we are basically collecting our dues. Okay. So what is the formula for the debt collection period? Debt collection period, the formula is equal to the average debtors, average sundry debtors we are having, divided by the credit sales. If credit sales are not provided, in that case we'll be considering the sales to be credit sales itself. Okay, and further we need to multiply it with 52 if we want to calculate the debtor collection period in weeks, and if we want to collect the debtor collection period in months, in that case we will be multiplying it with 12. Okay, so in this particular case we are just going to calculate the debtor collection period in months itself, so I'm multiplying it with 12, so the answer will be in months. Okay, so average debtors in the question, what is the amount of the average debtors? It is given to be what? The sundry debtor amount, it is given to be 300. The sundry debtor amount is given to be 300. Let me ascertain from the question itself. Yes, it is 300, and further the amount of the credit sale is given to be 3000. It is given to be 3000. So multiplied by 12, that will be the answer related to it. So 300 multiplied by 12 divided by 3000. So that is basically the debt collection period, that is 1.2 months. That is 1.2 months. And if we need to calculate the turnover ratio, debtor turnover ratio, that formula is related to what? That formula is credit sales divided by the average debtors, divided by the average debtors. That is basically the debtor turnover ratio. The credit sales are given to be in question, that is 3000, and the average debtors, that is equal to 300. So 3000 divided by 300, that is equal to 10. That is equal to 10. And that would be all related to this particular case study. So over here we are provided with the data related to the liabilities and assets for year 2019 and 2020, and further we'll be covering the case study. But before learning the case study concept itself, we will be just learning the concept related to WCF, that is what is working capital. So if we just look at the part that current assets, that is the amount of the gross current asset, that is a working capital. That is the working capital. And when we say that we need to calculate the net working capital, it is basically the current assets which are exceeding over the current liabilities over there. And if we say that what is working capital gap, if I say what is working capital gap, that is the part with which we need to finance. That is the part which we need to finance. So if you're having the excess of the current liabilities and but lesser of the current assets, that is a part that is a deficit, and that is to be financed over there. And further, the bank will not be financing 100% part of the working capital gap. They will not be financing 100% of the part. Some of the part has to be met up by the borrower there by way of a contribution. That can be from the long-term liabilities or the long-term sources which are over there, surplus long-term sources over there. And further, and the rest of the part can be basically met up by the bank finance itself. Okay, so if I say that we are having the current assets as amount 200, and further we are having the current liabilities amount of 250, in that particular case we can say that the working capital gap is 50. Working capital gap is 50. And if I just say if we just assume that the margin over there, that the borrower contribution over there, it is going to be 20%. What does it indicate? It indicates that 10 out of 50 it is to be contributed by the borrower itself, and the rest of the part of 40 which will be contributed by the bank itself. Okay, so that is the process over there. And we are having the different methodologies by which we can do a certain that what amount will be sanctioned to the borrower as per the working capital finance. For that particular purpose, we use a different methods like JAIIB committee method, which is also termed as a projected turnover method. I'm just writing it over here. That is a JAIIB committee method, or the projected turnover method, or the same name goes for the projected turnover method. And also we are having the MPBF methods, that is a Tandon committee method. So that is maximum permissible bank finance method. And there are three methods which were given by the Tandon committee: MPBF 1, MPBF Tandon committee 1, method 1, method 2, method 3. Method 3 was not accepted by the Reserve Bank of India, but these two methods were basically accepted by the Reserve Bank of India itself. But where do we apply which method? That basically depends upon the quantum of the loan, which is basically is to be extended to the borrowing firm itself. Okay, so if the amount is to be sanctioned, if the amount is to be sanctioned up to rupees 5 crore, rupees 5 crore to the small scale industry, and for the other industries, if the loan is to be sanctioned, if the working capital is to be sanctioned up to rupees 1 crore, in that particular case we'll be using the JAIIB committee method. But if the amount is to be financed above rupees 5 crore to the SSI, to the small scale industry, and above rupees 1 crore to the other industries, in that case we will go for the MPBF, that is a maximum permissible bank finance method over there. Okay, so that is related to it. And under the JAIIB committee method, it is based upon some of the assumptions. Let us have a look at it, because this particular case study is based upon the JAIIB committee turnover method only. Okay, so what are those assumptions? Let us have a look at it. Okay, so as per the JAIIB committee method, they divided the working capital cycle into 4 parts. They just assumed over there that whatsoever the working capital cycle is there for the firm over there, that as per the calculations of the JAIIB committee method, they will be assuming that there are 4 working capital cycles. And further they will be financing as per that particular part only. That is why they just basically divided the full capital requirement into 4 parts. That is 25% of the part is to be financed only. So they just said that in the 12 months, in the year, they are having the 4 working capital cycle. Now what is working capital cycle? Working capital cycle is a cycle which is related to that we just invested our money or cash over there, and we procured the raw material. Further, we just had furnished the goods, we just produced the final goods, we just sold the goods. It may be the case that we have sold it on credit, or it may be the case that we have directly sold it for the cash. And after we have recovered, from the creditors, or we have got the amount from in the form of the cash itself, the working capital cycle does complete. So as per the assumption of the NAC committee method, the full year is basically said to be having the 4 working capital cycles over there. And further, the calculations are based upon this only. So if the total working capital requirement for the year is rupees 100, we'll be saying that we will be financing 25% of the part. The bank will be financing 25% of the part, which is basically to be financed. And further, out of this 25%, of rupees 100, we'll assuming it to be 25 over here, as of 25% of 100 over there. And for the 5 is to be contributed, 5%, that is 5 rupees are to be contributed by the borrower, and the rest of the part related to 20 will be basically financed by the bank itself. So whatsoever the projected turnover, because in case of the NAC committee method or NAC committee turnover method, we do consider the projected turnover, whether it is an existing firm, whether it is a new firm, we will be basically go for the projected turnovers only, and we will be basically considering 25% part of the same only, out of which 20% part is to be financed, and 5% would be the contribution from the borrower itself, which can be made up from the long-term sources so available, or it can be through the new contribution by the firm itself. Okay. So now let's move to the table over here, which we are providing with the information of the assets and the liabilities. So for the different years for 2019 and 2020. So for this question specifically, we are basically assuming that 2019 is current year situation and 2020 is a projected situation. Okay, so I'm just give you we are just taking it as an assumption over here that 2019 is basically the financial year, previous financial year, and 2020 is related to the projected financial year. Okay, so we are provided with the total assets and total liabilities over there, and further we need to calculate accordingly. So in first question, it is given over here that we need to calculate the margin that is to be maintained as per the turnover method. Now I simply told you that the projected turnover method, NAC committee method, or the turnover method itself, one and the same thing only, and we need to calculate what? We need to calculate the margin requirement for the same. For that particular purpose, first of all, we will need to ascertain that is what is projected turnover. What is projected turnover over there? So over here we are provided with the sales in year 2019 and 2020. So in year 2019, the sales are given to be 2800, that is for the current year we can say, and for the 2020, that is for the projected year, we assumed the sales are given to be 3300. And I just told you that we need to take the 25% of the projected turnover. Now turnover is related to what? Turnover is related to the total sales. Okay, so 25% of 3300, that is the component that is to be financed, and for the margin is also to be contributed. Okay, so 25% of 3300, let us just calculate it. So it is 3300 into 25%, that comes out to be 825. This is the maximum amount. That is basically required by the firm over there, and also margin is to be maintained. I just told you, and 5% of the margin is to be maintained. We can simply say that 5% of 3300 into 5%, that will be the margin out of this 825. So 825 would be the margin. 825 is the total requirement, that is 25% of the projected turnover method, and for the 20% will be financed by the bank itself, and 5% is the margin that is to be contributed. Is that clear? So 165 is basically the margin amount over here, and the amount which will be financed, it is 3300 into 20%, or it is 660. It is a 660, or simply we can do calculate 825 minus the margin, that is 165, same amount, that is 660 over there. Okay, so that would be all related to this particular case study. So over here we are provided with the data related to the XYZ company, balance sheet of the XYZ company, and as per the first question we need to calculate the current ratio. Okay, so we are provided with the current liabilities and the current assets over there, and current ratio is quite simple, that is equal to the current assets divided by the current liabilities. Total current assets are given to be what? The total current assets are equal to 25200, and further the current liabilities, the total current liabilities are equal to 14700. So what would be the answer? 25200 divided by 14700, that is equal to 1.7142. So current ratio as per the data given is 1.7142. So that is the answer over here related to question number 1. So let's now move to the second question over here. It says we need to calculate the acid test ratio. Now acid test ratio or the quick ratio, one and the same thing, and further we need to ascertain the quick assets from the current assets. Okay, the formula for the acid test ratio is quick assets divided by the current liabilities. Now the current liability part we are already aware of, that is 14,700, and further which components are not to be considered under the quick assets over here, we are having the prepaid assets, prepaid amounts over there, or it can be the case related to the inventory that is not to be considered. Okay, so those are not to be considered in case of what? In case of the quick assets. Okay, so that is basically the inventory component will not be considered. The inventory component amounting 14,000 crores will not be considered. That is equal to what? That is equal to 25200 minus 14,000, that is equal to 11,200, or we can simply add them up all. Okay, so that is equal to 5,000 plus 4,200 plus 2,000, that is equal to 11,200, one and the same thing. So the benchmark ratio for the quick asset is equal to 1:1. So over here we are calculating 11,200 divided by 14700, and that comes out to be equal to 0.76. So the quick ratio we have calculated 0.76. I'm just writing it over here for the reference purposes. Current ratio we calculated it as to be 1.7142, and the quick ratio we have calculated it as 0.76. Okay, now let's move to the next question. Now let's move to the next question over here. It says calculate the net working capital. Now what is net working capital? Working capital is the total current assets. Working capital is the total current asset, that is a gross current assets. Okay, but in case of net working capital, it is the amount. It is the amount basically related to what? Related to what is the amount of the current liabilities exceeding the current assets over there. So it will be equal to what? It will be equal to current assets minus the current liabilities. Now the current assets we are having 25200. The current liabilities we are having 14700. That is a working capital. That is a net working capital. So 25200 minus 14700. Just let me calculate it again. 25200 minus 14700, and that is 10,500. I'm just writing it over here. Net working capital is equal to 10,500 over here. Is that clear? Now let's move to the next question over here, and we need to calculate the working capital gap. We need to calculate the working capital gap. Now the working capital gap definition is quite simple. That is basically equal to what? Just let me tell you. Working capital gap is equal to the current assets minus the current liabilities, but other than the bank borrowings. So we need to subtract the current liabilities from the current assets, but other than the bank borrowings over here. So over here we are provided that what are the bank borrowings? What are the bank borrowings? Is it mentioned over here? Yes, the cash credit component is related to what? It is related to the bank borrowings. So that is basically to be subtracted from the liability side. So the current assets we are having 25200, and further what is the finance part? It is on 14,700 minus the 3,200. Minus 3,200, that is equal to 11,500. So that will be the working capital gap. That will be equal to working capital gap, that is 25200 minus 11,500, that is equal to 13,700. So the working capital gap that we calculated is equal to what? It is equal to 13,700. Okay, and under the Tandon committee method, the financing is done based upon the working capital gap only. So the next question is related to the Tandon committee method only. There were 3 methods which were given by the Tandon committee, but third method was dropped by the Reserve Bank of India. Okay, so in the question itself, it is given that calculate the maximum permissible bank finance, that is MPBF, as per the Tandon Committee Method 1. Now, as per the Tandon Committee Method 1, what is the financed part? Let me just tell you. So you must be considering one thing, as when we will be considering whether it is a method 1, method 2, that what amount is to be financed. So working capital gap is the amount that is to be financed. Working capital gap is the amount that is to be financed. And how we did calculated the working capital gap? It is the current assets minus the current liabilities, but other than the bank borrowings. But other than the bank borrowings. Is that clear? Okay. So that particular amount is to be financed. So as per the maximum permissible bank finance method 1. Okay. So 25% amount of the WCG is to be maintained as the margin. It is basically is to be contributed by the borrower itself, and 75% of the part will be financed. So what will be the maximum permissible bank finance as per the method 1? It will be 75% of the WCG amount that can be financed. Okay. So over here we are having the WCG equal to 13,700. So multiplied by 75%, and that is the amount which can be financed, that is 10,275. So it is 10,275 is the amount which can be financed as per the MPBF method 1. So I'm just writing it over here. That is MPBF method 1. It comes out to be 10,275 amount which can be financed over here, which is basically maximally restricted to 75% of the WCG amount. Okay. Now let's move further to the next question. So if you know the basics, definitely you can answer at the earliest. So we need to calculate the MPBF as per the Tandon Committee Method 2. So as per the Tandon Committee Method 2, again the part which can be financed, it is related to the WCG only. But let me tell you one thing. In case of the method 2, the margins is to be maintained, not 25% of the working capital gap. It is related to 25% of the current assets. So the total current 25% of the total current assets, the margin is to be maintained. Okay. So WCG is what? WCG is 13,700 minus 25% of the total current assets. That is equal to 25,200. So it is basically 25,200 into 25%. That is the margin that is to be maintained. That is 6,300 is the margin over here which is to be maintained. And what is the maximum amount which can be sanctioned as per the method 2? 13,700 minus 6,300. That comes out to be 7,400. So 7,400 over here is the maximum amount which can be financed. So MPBF method 2, the maximum amount which can be financed is 7,400 crores. It is 7,400 crore. Is that clear? So let me just tell you again that in case of MPBF method 1, the margin is to be maintained as per 25% of the working capital gap. But in case of method 2, the margin is to be maintained at 25% of the total current assets. Okay. So all the information is already provided over here. So we just substituted the value and calculated the answer. Next question over here, it says that current ratio as per the Tandon Committee method 1. What will be the current ratio as per the Tandon Committee method 1? So if we consider cash credit component over here is not equal to 3,200, but as per the method 1, maximally it was equal to 10,275. So in that case, what will be the amount of the total current liabilities? It will be 10,275 plus 9,500 plus 2,000. That would be the total amount of the current liabilities. That is 21,775. And what will be the amount of the current ratio? The current assets, that is 25,200 divided by 21,775. That would be the current ratio. That would be the new current ratio if the finance has been made as per the Tandon Committee method 1. So that will be equal to 25,200 divided by 21,775, and that comes out to be 1.1572. And that comes out to be 1.1572. Okay, so that will be the answer for this particular question. Next question, it says that as per the current ratio, what will be the current ratio as per the Tandon Committee method 2? What will be the current ratio as per the Tandon Committee method 2? Let us have a look at it over here. So if the Financing has been done as per the method 2. What will be the financed amount? It would have been 7,400 crores. In that case, what will be the total current assets? Total current liabilities, it will be 14,700 minus 3,200. That was the previous CC limit, and the new CC limit would be 7,400. So that is our total current assets. That would be have been the new total current assets or total current liabilities in case the finance has been done as per the MPBF method 2. 18,900 over there. And what would be the new current ratio? 25200 divided by 18900. So 25200 divided by 18900, that is equal to 1.33. That is equal to 1.33. This would have been the current ratio if the financing has been done as per the MPBF method 2. Next question over here, it says borrowing by way of cash credit when compared with the Tandon committee method 1. What would have been the borrowing amount? So I have already mentioned the answer over here. That's as per the MPBF 1. The borrowing amount would have been 10,275, and as per the method 2, the borrowing amount would have been 7,400 crores over here. So that would be the answer. So correlation coefficient basically relates to a relationship between the two different variables. So those two variables basically we need to basically get a point at what is the relationship between those two values. And correlation coefficient is basically represented by R, and it values basically ranges from -1 to 1 over here. Okay, so 1 means if the value of R is equal to 1, it means there is a perfect linear relationship or direct relationship between these two. And further, if the R is equal to -1, in that case, it means there is a perfect inverse relationship between the two different variables. So we are here provided with the different two variables X and Y, and we need to calculate the amount, need to calculate the correlation coefficient. Now in the exam itself, there will be multiple parts of the question where you need to calculate the correlation coefficient or standard deviation or the mean values, and further it may also be asked that is related to that you need to calculate the different intercept values for the linear equation. Okay, so we will be learning them all. So what do you mean by correlation coefficient? So R is basically equal to what? It is equal to covariance of X and Y, and further divided by sigma X and sigma Y, that is related to. Now sigma X is basically standard deviation of X, and sigma Y is basically the standard deviation of Y that we need to calculate over there. You need to memorize only two formulas for the same. That is correlation, or that is covariance over here. First formula is basically related to covariance between the two different variables. Covariance over here is basically equal to xy, sigma xy divided by n, and further minus x bar multiplied by y bar. That is the formula for the covariance. And further for the sigma x or sigma y, I'm just simplifying, writing it for the sigma x first of all. It is equal to what? It is equal to the x bar sigma x sigma x square divided by n, and further subtracting the x bar square, and for the under root of the same. So that would be formula related to sigma x over here in this particular case. Is that clear? Okay, so same goes for the sigma y over here. That is equal to summation of the y square divided by n minus y bar square and further under root of the same. Is that clear? So by using this particular formula, we will be solving the value of the R over here. So what would be the value of R? That is covariance divided by sigma x and further sigma y over here. So we will be now concentrating on the first formula that is related to the covariance. Okay, so we will be just forming a particular table over here that will basically make the calculations of the questions quite easier. Over here in the table itself, we will be having the values of x and further y. Then we will be solving it for x square, y square, and further xy. Okay, so that is what you need to calculate. I have simply formed the table for you so as to make you understand that how you just need to make the table out of it. So we are having the 5 values for x and 5 values for y, for which we have formed the table over here. So over here we are having the table related to x 1 2 3 4 5, and further for y 11 22 34 43 and further 56. So we calculated x square for each term over here and then y square for each term over here. Then we just multiplied x into y for all these values over there. And also we had the total in the end. So in the last column over here, it is basically related to total of these all terms over here. So first of all, we will be calculating the covariance. So it is equal to sigma xy. Now sigma xy total is equal to 609. So it is 609 divided by n, that is the number of the terms, that is equal to 5 minus x bar. Now what is actually x bar? X bar is mean. X bar is mean. So it is 15 divided by 5. So x bar is equal to 15 divided by 5, that is equal to 3. And for y, it will be equal to 166 divided by 5. 166 divided by 5, and that comes out to be 166. So it will be 166 divided by 5. That comes out to be 33.2. 33.2. So it will be x bar into y bar, that is 3 into 33.2. Okay, so we'll be just solving it. So that is equal to 609 divided by 5, that is equal to 121.8 minus 33.2 multiplied by 3, that is equal to 99.6. We need to subtract minus 121.8, and that comes out to be 22.2. So answer over here related to covariance, it comes out to be 22.2. I'm just writing it over here. So covariance over here, it comes out to be 22.2. And now we need to calculate the sigma x and sigma y. We need to calculate the sigma x and sigma y. I just told you what is the formula for sigma x. It is equal to x square, summation of x square divided by n minus x bar square and under root of the same. That is the formula. Okay, so summation of x square, that is basically pertaining to this particular column over here. So it is 55 divided by 5 minus x bar square. Now what was x bar? X bar we calculated it to be, I'm just writing it over here, x bar was equal to 3 and y bar was equal to 33.2. So it is basically 3 square under root of the same. That will be the value of the sigma x, that is equal to 55 divided by 5, that is equal to 11 minus 9, that is equal to 2, and under root of the same, that is equal to 1.414. So sigma x over here, I'm just writing the value, sigma x over here, it comes out to be 1.4142. Okay, now we need to calculate the sigma y. Just we will be substituting the value for the same. So sigma y, that will be equal to y square, summation of y square, and further divided by n minus y bar square, and further y bar square summation, that is basically equal to 6746. So 6746 divided by 10, and y bar was equal to 33.2 and square of the same, and we will be simply solving it. So it is equal to 33.2 multiplied by 33.2, that comes out to be 1105.56, and further 674.6, and that is what you need to solve. So 674.6, so it will be basically equal to what? It will be equal to the, I think there was some mistake that we made in the previous part also. So just let me calculate the sigma x value, because I just considered the n equal to 10 in the previous case too. Okay, so I'm just solving the sigma x value again. So that will be sigma x square, that value is basically 55. So that was basically, actually we calculated right, but over here we need to replace 10 by 5, because over here we are having the terms equal to 5 only, and when we just squared it, the value will come out to be 33.2 multiplied by 33.2, that comes out to be 1102.24. 1102.24. I'm just rewriting it. So it will be 6746 divided by 5, and that comes out to be 1349.2 minus 1102.24, and that comes out to be 246.96. Under root of the same, and that will be equal to 15.71. So we are having the sigma x value equal to 1.414, and for the sigma y is equal to 15.714. Okay, so here we are having all the values with us, and we just need to replace the values so as to calculate the value of r. So r is equal to covariance of xy, we just calculated it to be 22.2, and further divided by sigma x, which is equal to 1.4142 multiplied by sigma y, that is 15.714. So will be 15.714 multiplied by 1.4142, and that comes out to be 371. So 22.2 divided by 371.47. Okay, so here will be the answer, that is 22.2 divided by 371.47, and that comes out to be 0.0597. So here comes the value of R, small r, that is a correlation coefficient, that is equal to 0.0597. So there is a very weak or weak positive relationship between the different variables x and y. Is that clear? So here we are having the answer over here. So I'm just writing all the values over here, writing down. So R is equal to 0.0597. Okay. I think again I just made a wrong calculation over here because I just cross-checked it on my end. So it was 1.4142 multiplied by 15.714. That comes out to be 22.2227. I'm just writing it down, 22.222227, and that will be calculating. So R is equal to 22.2 divided by 22.2227, and here we are having the value that is 0.9989. So there is a strong relationship between the two different variables. Sorry for the calculation mistake. It was 0.9989 value that we are getting over here. Okay, and further once we have calculated the value of the small r over here, it will be asked in the question that you need to calculate the different intercepts that is related to, because over here we are solving the correlation coefficient which are basically linear only, So in case we are considering a line, what is the slope of line? It is basically, what is the equation of line? It is equal to y is equal to a plus bx. This is the equation of line over here, and over here a relates to the y-intercept, that the point at which the line will be basically intersecting on y-axis. So this is y-axis and this is x-axis. So a is what? A is basically y-intercept. And b over here is the slope of line. And it may be asked in the question that we need to calculate the a and b value. That is basically related to the regression. That is related to what? That is related to regression. Now what is the value of a and b? So formula for b, that is equal to covariance of xy and divided by the sigma x square, and for a, that is equal to what? That is equal to y bar minus bx bar. That is a formula that you need to use so as for calculation for the b and a. That is for usage for the value, for calculating the value of b and a over here. So covariance we have already calculated. So that comes out to be, that was basically equal to what? That was equal to 22.2. And further divided by sigma x that we have already calculated, that is 1.4142, and square of the same. So over here we are having the value of b is equal to 1.4142 multiplied by 1.4142, and that comes out to be 1.999. Okay, so it will be 2.2 divided by 1.9999. That comes out to be equal to 11.1. So so value of b is equal to 11.1, and for for the value of a, here we are having y bar is equal to what? Y bar we have already calculated, it was equal to 33.2, and for the minus b we have already calculated. That is 11.1, and what is the value of x bar? That is equal to 3. Over here. So 11.1 into 11.1 into 3, that comes out to be 33.3. So there must be some differences between the points over there. That is why it is coming in negative. Otherwise, it will be mathematically, it will be equal to 0 only. Okay. So I just told you the methods over here related to the formulas over here. So as for the use for the calculation of the different points related to that, how we can calculate the covariance, just remember this formula for calculating the r over here, that is a correlation coefficient, covariance xy divided by sigma x sigma y. And for the related to sigma x formula, I just told you that is sigma x is equal to what? It is equal to the x square summation divided by n minus x bar square and further under root of the same. Okay, so these are the formulas that you need to memorize, and further you can solve the questions based upon that. So GDP is the value that of the goods and services that have been produced in the territory of the country, and that is GDP itself. And we need to calculate the GDP at the cost factor over here in the first question. So we are provided with the different terms and figures over here, and the particular data is provided like consumptions, government spending, import subsidies, etc. So first of all, we will be calculating the GDP by the expenditure method. So what is the formula over here? That is Sig XM. So what is it is Sig XM, that is C plus I plus G. You need to memorize this, C plus I plus G plus X minus M. Okay, so what it is actually related with? C is for the consumptions, C is for the consumptions, I is for the, I'm just writing it over here, C is for the consumptions, I is for the government investments, for the gross investments I can say, not government investments, it is gross investments. G is basically related with the government spending or part over here. X is related to the export, and further M is related to the imports over here. So we are provided with the data over here. We will be just substituting the values. That is, C is given to be 60,000, and for the investment part is given to be 50,000 over here. And after that, the government spendings given to be 15,000, plus export part is given to be 1,10,000, and the import part is given to be 70,000. That is to be subtracted. Okay. So the answer would be related to 60,000 plus 50,000, 1,10,000 plus 15,000, 1,65,000, and plus 1,10,000 minus 70,000. So it is 40,000 over here. So it is 40,000 over here. So 60 plus 50, that is 110 plus 15. Sorry, 110 plus 15. It would be 125. 1,25,000 plus 40,000, that is equal to 1,65,000. That would be the answer. But now over here we have calculated the GDP by the expenditure method. This is not the GDP at the cost factor. So in case of GDP at cost factor, you need to subtract all the indirect taxes from the same. So for that particular purpose, it will be related to the GDP we have calculated, and further minus the indirect taxes. But we need to subtract the subsidies so far which have been reduced by the government itself. Okay, so whatsoever the indirect taxes have been basically levied by the government, subtracting the subsidies. Okay, so that will be basically equal to what? That will be equal to 1,65,000, and further the indirect taxes figure is given to be what? It is given to be 12,000. So we need to subtract 12,000 minus the subsidies part, which is given to be 8,000 over here. So it will be 1,65,000, and further minus 4,000, that will be equal to 1,61,000, and that is our answer. That is GDP at the factor cost. Okay, so you need to memorize that. First of all, you need to calculate the GDP by the expenditure method. After that, you will be subtracting the indirect taxes from the same, but must be keeping in mind, if the subsidies part is given over there, you need to subtract the subsidies from the indirect taxes. Okay, so that will be basically related to what? That is the GDP at the cost factor. So next we need to calculate the GNP. Before moving on to the GNP concept, just let me tell you that GNP stands for the gross national product. Whereas in the case of the GDP at cost factor, before calculating the GDP at cost factor, we calculated the GDP by expenditure method, which is said to be GDP at market price, Okay, so GNP concept is basically a nationality concept. It is basically related to what? It is related to nationality concept, that whatsoever has been produced or rendered by the nationals over there. So in that particular part, we do consider the income or the capital gains which we have received overseas, and also we need to subtract the amount of the payments or the capital gains which have been earned by the foreign nationals domestically. Okay, so whatsoever the amount our nationality people, citizens have basically earned overseas, that is to be added up, and whatsoever the foreign residents have earned over domestically, that is to be subtracted. Okay, so that is a nationality concept. Whereas if we look at the GDP, that is a territory concept. I just told you that it is related to that whatsoever has been produced and further rendered over here in the territory itself, that is basically related to what? That is related to the GDP. Where GNP is a nationality concept. Okay, so now we will be calculating the GNP at GNP first of all. So we will be calculating the GNP, that is a gross national product. Okay, so as for calculating the GNP, you'll be subtracting the NFIA, that is GDP minus NFIA. Now what is NFIA? This is net foreign receivables. This is related to the net factor income from abroad. We can basically name it as net factor income from abroad, or we can say net receivables also, and I also can name it net receivables. Okay, so in the last question by expenditure method, that is C plus, just let me write it over here again, that is C plus I plus G plus X minus M. That was the formula, and we just calculated it to be 1,65,000. So that minus what? Minus the income that we have gained from overseas. That is to be added up. Okay, so it will be 20,000 will be adding up, but we need to subtract. The amount that we have basically paid, to the foreign nationals, that is 3,000 over here. So that is to be subtracted. So that is basically related to the GNP. Okay, so it is 1,65,000. 20,000 minus 3,000, that is 17,000. So 1,65,000 plus 17,000, that is equal to 1,82,000, and that would be the answer related to the GNP, that is gross national product over here. So the case study says, while releasing the data relating to the inflation increased by the government, it is observed that the consumer price index based index is basically inflation is increased to 12%, that is CPI is increased to 12%. WPI, that is wholesale price index, inflation is increased to 9%. And third point, it says the government claims that due to implementation of central pay commission, there is increase in demand of goods and services, leading to increase in the consumer price. Because there have been increase in the, because it has been basically there is increase in the demand of the goods and services, due to which the consumer prices have increased. Fourth point, it says further, also due to increase in production, the wages, salaries of labor are also increased. There is increase in the inputs, leading to increase in the WPI. So it basically leads to what? That the input costs have been increased, due to which the WPI has been increased. Okay, so that is the case study it is related with. And further, the question, it says the inflation caused by the information given at point 3 is not called as what? Core inflation, demand pull inflation, cost push inflation. So when there is regular increase in the prices of the goods and services so being provided, that is basically said to what? That is said to be the inflation itself. That previously, if we were able to purchase 10 goods out of rupees 100, and right now out of 100 rupees we are able to purchase the same goods quantity 8 only, that basically relates to what? That is basically our purchasing power is lowered, it is now reduced, and that is basically the inflation. Okay, so it is having two, it can be measured in two manners, that is a CPI. In case of the CPI, that is a consumer price based inflation, consumer price index. In that particular case, the inflation is basically measured in a way so as to what increase in prices which are being used at the consumer level, because consumer is going to be the main component in the system over there. And further, what is an increase in the prices related to the consumer, that is the CPI, and this is also said to be the consumer, or it is also said to be the core inflation. And the second type of the inflation, it is a wholesale price index. So when you are looking at the increase in the prices at the manufacturer level, that is basically the wholesale price index. Over there, the selected commodities and the services are being basically priced, and whatsoever the increase in price over there, and that is said to be what? That is said to be the WPI over here. So inflation in our economy is having the positive as well as the negative impact. It lowers the purchasing power, that is a negative impact. And also if the economy is in recession, in that particular case, the inflation helps the economy to bring it out of the recession over there. Okay, so that is a positive point related to it. So now, as per the question, it says the inflation caused by the information given at point number 3, which basically relates to, let's say that government claims that due to implementation of the central pay commission, there is increase in demand of goods and services. Why? Because an extra amount was basically distributed among the different employees, and further now they are having more surpluses with them, and definitely they can do purchase more. Okay, so that will basically lead to what? That will basically lead to increase in demand of the goods and services, and that is said to be what? That is said to be the demand pull inflation. Now inflation can be caused by two reasons. One of the causes is basically related to increase in demand, and the other one, it is related to when there is increase in the input cost. When there is increase in the input cost, in that particular case also, because there is a simpler thing that we need to remember first of all, that the manufacturer wants to produce wants to produce in which he'll be getting the maximum profits, in which he'll be making the maximum profits. Okay, so if I take the case that the input costs have been increased, if the input costs have been increased, that will basically lead to what? That will basically lead to that our margin will be lowered. If previously I was able to produce a product at rupees 10 and further was selling into the market at rupees 20, I was just making a profit of rupees 10 per product. But now the input cost is now increased to 13 rupees, and now I'm basically selling the product at the same price at rupees 20, and I'm making a profit of rupees 7 only. And definitely I'll be lowering my manufacturing in that particular case, because I'm not able to make that much profit in this product itself. So when there will be shortage of the product, there will be increase in demand. Okay, that is basically related to what? That is related to the cost push inflation, due to which the inflation is there due to the increase in the input cost. So two are the main causes over there: demand pull inflation and the cost push inflation. And the point number 3 over here, it relates to the demand pull inflation. Okay, so question number 1 over here, answer is option B, that is demand pull inflation. But we need to tell, we need to tell over here, the inflation caused by information given at point 3 is not called as, it is not called as what? It is not called as a core inflation, and further it is not the cost push inflation. Okay, so 1 and 3 would be the right answers over here. Okay, now let's move further. Question number 2, it says the inflation caused by the information given at point 4 is not called as. Now at point 4, the information given is related to that there is increase in the input cost. So when there is increase in the input cost, the inflation caused by such as is called as what? It is called as cost push inflation. It is called as a cost push inflation, that you due to increase in the cost, there is increase in inflation, that is the cost push inflation. So the answer over here would be related to what? It would be related to the option number 3, because we need to tell which is not called as, which is not called as. So core inflation and demand pull inflation are the wrong nomenclature over there, because it is named as cost push inflation. And core inflation is basically the name suggested for CPI, that is a consumer price index over there. Okay, so that would be all related to this particular case study. So case study says diagram depicts the ISLM curve model theory of interest. OX represents the different income levels from Y1 to Y5. OY represents the different interest levels from R1 to R5. Okay, so the case study that is based on the ISLM curve, that is basically a synthesis which was given by the Hicks and Hansen from the classical theory of interest and further the James theory of interest over there. So there was a synthesis between these two, and ISLM curve was given. IS is basically related to the income saving curve, and LM curve is related to the liquidity and money supply curve over there. Is that clear? And that is basically synthesis between what? That is a synthesis between the classical theory of interest and further the James theories of interest. So we need to understand first of all that how did we generated the IS curve and how did we generated the LM curve. Then we will jump upon the questions over there. So first of all, we are going to consider related to the IS curves over here. Let me just clear some space over here so that I can make you understand related to those. Okay. So first of all, you must be understanding that as per the classical theory of interest, just let me write it over here, that as per the classical theory of interest, so that if there is increase in, there is increase in the income over there, definitely there will be increase in the investments and savings you will be making. So on the x-axis we are having the savings and incomes, and on the y-axis we are having the ROI. We are having the ROI over here. So if the income is increased, in that particular case you will be saving more. You will be saving more. So over here we are having the income curves. Different income curves are over here that we will relate with the Y1, Y2, Y3. These are the different income curves over here. And further, whenever savings do increase, when our income is increased, in that case our savings are increased. So the slope of the slope as per the classical theory of interest, it will be left to right downward. It will be left to right downward, and that is basically representing what? So if we just draw the curve from over here, in that particular case, if we just draw the curve from over here, if we are having the income on the x-axis and ROI on the y-axis, in that case this curve will be from left to right downward. Okay, so that is what? That is the as per the that is a IS curve we can say over here. Okay, and further, as per the James theory and as per the James theories of liquidity preference, over here we are having the quantity of money, quantity of liquidity, and over here we are having the ROI. Over here we are having the ROI, and further when there are different levels of the income over there, because as per the JMK's theory, he basically considered two factors. One, it was related to that if the people do have the high income, they will be keeping higher amounts with them for for the transactional motives. And further, if the rate of interest is higher, in that case people will be investing the amount and will be keeping lower amount with them. Okay, so that was as per the JMK's theory. So if the income is basically, if we are having a fixed money supply, if we are having the fixed money supply, and further if we say that the rate of interest is increased, in that case our curve will basically shift upward. Our curve will basically shift upward. And also we can do predict, and also we can say that if there is increase in the income, if there is increase in the income, our curve will basically move from left to right. Our curve will move from left to right over here. Is that clear? I just told you that if the rate of interest will increase, our curve will move upward, and further if the income is increased, our curve will move from left to right over there. Okay, so we can say something that our curve will move something like left to right upward if the income is increased. If the income is increased, in that case our curve will move from the left to right upward in that particular case. That is a LM curve. That is how basically the synthesis was given by the Hicks and Hansen over there related to ISLM curve over there. Is that clear? So first question over here, it says which is true in this particular regard of the curve. So curve is based on investment and saving. So curve is not just based upon the investment and saving, it is basically a function between the rate of interest due to the investments and saving over there. Okay, so ROI over here is determined by the level of the saving and investment. That is true, but it's not the case that is curve is based upon the investment and saving over here. Okay, so option A is not correct, whereas the option B will be the correct one. Option C over here, it says when the income rises, the rate of interest also rises. That when the interest when the income is increased, or we can simply say that when the income is increased, in that particular case the rate of interest also increases. Yes, definitely when the income is increased, the rate of interest is also increased, but we cannot say it as in the regard of the curve itself, because it was asked that which is correct in case of the curve itself, which is correct in the case of the curve itself. So over here, when the income rises as a general trend, the income rises over there, the interest rates also increase. Let's move to the next question. It says diagram is at point E, diagram equilibrium is at point E. What is not correct in this particular point? So first of all, let me tell you that particular this point E, when LM and IS curve are drawn as per the synthesis, in that particular case, the money supply and money demand is in equilibrium. And also these are equilibrium as per concerned with the rate of interest and the investment and savings and the liquidities over there. Okay, so that is related to the equilibrium point over here as per in the ISLM curve over there. Okay, so at this point income and ROI stand in relation to each other. Is it correct? It's not so. Investment and saving are in equilibrium. Are investment and saving equilibrium? Investments are saving and equilibrium? No, it's not so, because it's not related to investment and saving only, because it basically takes the classical theory of interest from the investment saving to ROI preview. Okay, not related to the IS investment and saving curve only. Okay, and the third one, it is related to demand for money is in equilibrium with the supply of money. Yes, it is correct one. As per the ISLM curve, there is equilibrium in the demand and further the supply for money over there. So option C over here is the right answer. Next question over here, it says ISLM or determinate theory of interest as depicted in the diagram is based upon what? So we need to term that it is based upon what? Investment demand function, saving or consumption function, liquidity preference function, quantity of money. Quantity of money. So it's actually based upon all of this. It is based upon all of this. So all would be the right answer in this particular case. So from the classical theory, we basically just predicted that whatsoever the investment will be made and what amount is demanded. And from the saving or consumption based, that was basically as per the JM Keynes function, na? Because it basically said that more the income the person will be having, more the income that will be using for the consumption purposes, for the transactional purposes. And the third one, it is related to liquidity preference, that what would be our preferences under the different scenarios. And the fourth one, it is related to quantity of money that is particularly available. Okay. So it is based upon all these four. So so all of these will be the true. Case study related to which says the following information is available on the price index as at close of the March of the respective years. Further, we are provided with the data related to the base year, and further related to 15, 16, 17 and 19 related to WPA, that is a headline inflation, and CPI, that is a core inflation. And further, we need to solve the question based upon that. And first question over here, it says, what is the ratio of the headline inflation in the year 2018 on year to year basis? Whensoever we are to calculate the ratio of the headline inflation from, or any other ratio from year to year basis, we'll be considering the current year, that is 2018 over here, and from the last year itself. So for the 2017, it is 121, and for the current year, it is 134. So what will be the WPA? It will be 134 minus 121, that is equal to 13, and we'll be comparing it with the this particular year ratio itself, with the previous year ratio itself. So what will be the ratio year to year basis? It will be 13 divided by the 121. 13 divided by 121, and that would be the answer. So 13 divided by 121, and percentage, that is 10.74%. So year on year basis, it is 10.74% for the year 2018 over here. In the next question, we need to calculate what is annual average core inflation over the entire period. So kindly try to understand this. Over here, we need to calculate the annual average, and what related to core inflation. Core inflation is related to what? It is related to CPI, that is consumer price inflation over here, consumer price index over there. So it will be for the year, it will be over the 5 years average. It will be over the 5 years average. So we'll be taking the difference between the last year, that is 2019, and the base year. So for the base year, it is 100, and for 2019, the CPI is 159. We will take a mode value of this, that is the absolute value, that is 59 over here. And we need to calculate the average. So we will be dividing it divided by 1, 2, 3, 4, 5. So we will be dividing it by 5. So 59 divided by 5. 59 divided by 5. Sorry, 59 divided by 5. It comes out to be 11.8. It comes out over here 11.8. And further, we need to calculate the average core inflation over the entire period. So over here, we will be considering the base year, because we want to calculate it over the period. So we'll be considering the base year. So it will be equal to what? It will be equal to 11.8 divided by 100%, that is equal to 11.8%. That is equal to 11.8% over here. Is that clear? So that is how we will be calculating. So whenever it is said that we need to calculate to year basis, then we'll be considering the last year. And further, when it is said to be that we need to calculate the average, in that case, we will be casing the upmost and the base year, and further finding the differences between them. Then further, we will be calculating the average of the same. So we will be dividing by the total number of years which are to be looked into for, and further we will be basically calculating the inflation based upon that. Okay, so that is related to question number 2 over here. And in the last question, it is said over here that on a year to year basis, the core inflation was highest in which of the years, as in 2016, 17, 18 and 19. Okay, so for that particular purpose, I just told you that how we can do calculate year on year basis. If we want to calculate it for 2016, in that case, we will be taking last year. That will be equal to what? That will be equal to, if I say we want to calculate it for 2016, that will be equal to 124 minus 110 and divided by 110 over there. And further, if we want to calculate it for 2017, that is particularly this one. In that case, we'll be calculating, because we want to calculate it for core inflation, that is CPI. So 131 minus 124 divided by 124, and further for 2018, it will be equal to what? It will be equal to 149 minus 131 divided by 131, and further for 2019, it will be equal to 159 minus 149 divided by 149. Now simply we need to solve this all. So that will be equal to 14 divided by 110, because over here it will be 14 divided by 110, that is equal to 12.72%. 12.72%. And further in the second case it will be equal to 131 minus 124 divided by 124, that is equal to 5.6%. For 2018 it will be equal to 149 minus 131 divided by 131, that is equal to 13.74%. And for the last one it is 159 minus 149 divided by 149%, that is equal to 6.71%. So clearly for the year 2018, this one was the highest. This one was the highest, and that would be all related to this particular case study. So this is, as on the end of the previous financial year, XYZ Bank is having the total advances of rupees 80,000 crores. ANBC, that is adjusted net banking credit, is given to be 75,000 crores. Agriculture advances, all the other advances have been mentioned, and we need to answer accordingly. Question number 1 over here, it says, what is the target for agriculture advances in terms of the amount over there? So you must be knowing first of all that the advances for the PSL, for the target for agriculture under the PSL, it is 18%. It is 18%. Okay, so the overall target is 40%. So if nothing is mentioned, we will take in this for the scheduled commercial banks only. And out of 40%, 18% target goes towards the agriculture target. And that is basically of ANBC or CEOBE, whichever is higher. It is basically related to the ANBC, that is adjusted net bank credit, or CEOBE, that is credit equivalent of off-balance sheet exposure, whichever is higher. But over here in the question, we are not provided with the CEOBE, so we'll be considering only and only the ANBC, which is given to be 75,000 crores. So 75,000 crores into 18%, and that will be our answer. That will be simply be our answer. So over here it is 75,000 into 18%, that is equal to 13,500 crore. So question number 1 over here, the answer will be 13,500 crores. Okay. Now let's move to the next question over here. It says, what is the target for MSE advances in terms of amount? So what is the sub target for MSE, that is micro small enterprises? It is 7.5% of ANBC. Now ANBC is, again, it is given to be 75,000 crores. So 75,000 crores multiplied by 7.5%. Here it comes out to be 5625 crores. Here it comes out to be 5625 crores. Further, let's move to the next question. It says, what is the target for the weaker section advances in terms of amount? So previously for the weaker section, the target was 10%. I already just told you that if nothing is mentioned in the question specifically, you need to answer it for the scheduled commercial banks only. Okay, so previously it was 10%, but now it is increased to 12%, and it is to be increased in a phased manner by financial year 2024. But you will be considering it at 12% only. If some question is asked based upon the weaker section, you will be considering it for the round of 12% only. And for the regional rural banks, what is the weaker section target? It is 15% for the regional rural banks. Okay, but we will be using 12% for the calculation purposes. So 12% of 75,000 crores. So 75,000 crores multiplied by 12%, and that comes out to be 9,000 crores. So question number 3 over here, the answer will be 9,000 crores. You must be having the basics related to the PSL, and also must be remembering the subcategory sectors under the PSL itself. So what is the target for the priority sector advances in terms of the amount? So overall priority sector advances, what will be the target? It will be 40%. It will be 40% of the ANBC. So 75,000 crores into 40%, that is overall target, is amounting 30,000 crores. For regional rural banks, for small banks, the target is 75%. The target is 75% of ANBC or CEOBE, whichever is higher. And also for the urban cooperative banks. Also for the urban cooperative banks, previously it was 40%, but now it is to be increased in a phased manner towards 75%. Okay. And for the scheduled commercial banks and the foreign banks, it is 40%. It is 40%. Is that clear? So that would be all related to this particular case study. So it says that ABC Limited wants to purchase machinery for expansion of its manufacturing capacity, for which they have requested to sanction a term loan. Okay, the important aspects related to term loan are given over there. Before starting with it, let me tell you that what DSCR is. As the name suggests, debt service coverage ratio basically indicates that whether the firm would be able to service its installments or not. Okay, so whatsoever the operating income we are having and whatsoever the amounts which are to be paid, that is basically related to it. So in the numerator part, we are having the operating income, we are having the operating income in case of the DSCR in a numerator, and further in the denominator we are having total debt service. Total debt service, that is a formula related to it, but I'll just tell you another formula too, which we'll be using so as to solve the questions over there. Okay, so now if the DSCR is lesser than 1, what does it indicate? That indicates that let me give an example, that if we are having profits of 100 and we are having the installments so as to pay of rupees 110, what does it indicate? Here we do not have the resources so as to service our installments. That is a case over there. Okay, and that is not acceptable. That is not acceptable. Even if the DSCR is equal to 1, we have not keep up with any of the cushion with us, so it may create a problem in the times to come. So DSCR must be higher than 1 and we must be maintaining some of the cushions, so that if there is some diversion or some deviation in the profits over there, projected profits over there, we must be able to recover our installments in that particular case too. Okay, so let us take the question now. So the points are given to be that the loan will be repayable over 5 years. So that is a tenor of the loan that is given. Monthly installment of the loan is loan shall be rupees 1 lakh plus interest due. So whatsoever the interest is charged, whatsoever the amount is loan EMI is to be given per month, that is given to be rupees 1 lakh. Average annual payment of the interest shall be rupees 5 lakh rupees. So that is related to what? That is related to the annual payment of the interest which will be there. Okay, so the bank will be sanctioning the loan only when the DSCR is around the ideal or the benchmark level of 2. So benchmark level of DSCR is 2, and for the bank will be sanctioning loan when it will be basically above the benchmark rates over there. Further, the firm expects to earn annual profits after tax. So PAT is what actually? PAT is profit after tax and depreciation. So PAT is given to be 25 lakhs over here, and PBT and the depreciation amount. So PBT, that is profit before tax, is given to be what? It is given to be 40 lakh rupees over here. It is given to be 40 lakhs over here, and we need to calculate the DSCR in this particular case. So what is the formula for DSCR? The formula that we will be using for the calculation purposes, it is PAT, that is profit after tax, plus the depreciation, because depreciation is non cash expense, plus the interest component that will be charged over there, and divided by the interest, annual interest that will be charged, plus the EMI amount or the principal amount that is to be paid. Okay, so that is an annual amount that will be considered. So PAT in this particular case, it is mentioned to be what? It is clearly given that it is equal to 25, and further the depreciation is also given. It's given over there but not directly. Outcome, because we are provided with the PBT and the depreciation, that is before tax and the depreciation. So PBT minus PAT, because we are over here provided at the PBT and the depreciation amount is given, so we can do a certain the depreciation from over here. So depreciation over here will be equal to 40 minus 25, that is equal to 15 over here. I'm just substituting the value, that is plus 15, and plus interest amount. So the annual interest amount is mentioned to be what? It is mentioned to be 5 lakh rupees. Okay, so I'll just adding 5 to it, and further the annual interest amount again it is 5, and further let me tell you that the installment amount per month it is 1 lakh rupees. 1 lakh rupees, and what will be the annual installment? It will be 12 lakh rupees. So it will be 15 plus 25, that is equal to 40 plus 5, 45 divided by 17. So 45 divided by 17, that will be our DSCR. So 45 divided by 17, that is equal to 2.647. That is equal to 2.647. That will be our answer for the DSCR. So can the loan be sanctioned in this particular case? Yes, definitely we can do sanction the loan, because we are in a very comfortable position over here, and it is above the benchmarks too, as per the bank's policies and procedure over there. So DSCR, I'm just mentioning over here, the DSCR which comes out over here, it is 2.647, And what was the formula for the same? It was profit after tax plus the depreciation plus the interest amount to be credited, and further divided by the annual interest plus the annual installments to be paid. Is that clear? So that is related to the formula over here. So now let's move to the next question. Question number 2 over here. It says, if the DSCR is substantially higher or lower than the benchmark level of 2, which of the following option is used by the bank? So it says that if the ratio is substantially lower, the bank can ask the borrower to put in interest-free long-term funds and reduce the amount of the term loan in that particular case. So definitely, if the DSCR is substantially lower means what? That our operating income is lesser than that of the DSCR, or we are not able to reach the DSCR to the benchmark levels over there. Definitely, the bank will ask that you must be reducing the term loan amount. That you're trying to reduce what? You're trying to reduce the denominator factor over there, and further you're going for what? You're going to add the interest-free long-term funds. Interest-free long-term funds are those funds in which you do not have to pay the interest, where you can, if you can mobilize those, definitely you must be going for that. Okay, so that is true. So option 2, it says, if the ratio is substantially higher, in that case the bank can ask the borrower to squeeze the repayment period. So let us take the case in the question itself. The loan was to be repaid in 5 long years. It was to be repaid in 5 long years, and further the installment amount was rupees 1 lakh. So the bank can ask for the things so that what? So as to reduce the repayment period to 3 years. So if the repayment period is reduced to 3 years, in that case, it may be the case that your installment will basically now become, let us assume that it will just become 1.5 lakh per month. So that will basically do what? That will basically reduce the DSCR. Now, what is the main purpose of reducing the DSCR? Because you are having substantially higher DSCR. You can repay the amount, and further you can repay the loan amount in lesser repayment period too. So that particular purpose, for that particular purpose, this will be suggested by the bank so as to reduce the repayment period. Third, it says, if the ratio is substantially lower and the borrower is not in a position to put interest-free long-term funds, the term loan sanction can be refused. Definitely, if the DSCR is lower and further you do not want to reduce the term loan, the firm do not want to reduce the term loan amount, do not want to go for the interest-free long-term funds, they cannot mobilize. So that definitely the bank will not be sanctioning the loan and will be refusing the same. So option 4 over here, that is any of the above, is the correct one. That is any of the above is the correct one. Okay. Next question says, we need to calculate the interest coverage ratio. So interest coverage ratio is somewhat related to DSCR, but it basically covers the interest component only. Whereas in the case of the DSCR, we are covering the interest as well as the term loan component. But over here, we will be covering only and only the interest component. So the formula for the ICR is same as that of the DSCR, that is PAT plus depreciation plus interest, annual interest over there, but divided by interest only, annual interest only. So PAT is basically 25 plus depreciation was we calculated to be 15. Interest is basically 5 lakh per year. Average interest is given over there and divided by 5. So that would be what? That would be equal to our ICR, that is the interest coverage ratio. So 25 plus 15, 40 plus 5, 45 divided by 5. So ICR comes out to be 9 over here in this particular case. Okay. So that would be related to this particular case study. So it says, by using the monetary policy, Reserve Bank of India regulates the money supply, availability of the money so available, and also the cost of money, that is the rate of interest. For this purpose, it makes use of a number of tools which include repo rate, bank rate, reverse repo rate, marginal standing facility rate, statutory liquidity ratios, CRR, cash reserve ratio, market stabilization scheme, and based upon that we need to answer the following questions. So let us have a look at the first question over here. It says, which of the following, change in which of the following funds are available with the banks for lending purpose. So if we change which of the following tool percentage, in that case, the bank will be having that basically having an impact on the funds which are available with the bank itself. That is a question that we need to answer over here. So first it is a repo rate, second it is a bank rate, third it is a cash reserve ratio, and fourth one it is a all of the above. So what is repo rate? Repo is basically repurchase offer. Like if a bank is having surplus of the securities which are unencumbered securities on which no charge has been created so far, So those securities can be sold to by the bank to the Reserve Bank of India, and Reserve Bank of India will be providing liquidity to the bank over there. But there is a condition that the bank A will be purchasing these securities so sold at a predetermined price at a predetermined date over there, and that is why it is said to be what? It is said to be the repurchase offer. So it's kind of bank is getting the liquidity from the securities it is having, surplus securities it is having, and further it is having the obligations as to purchase them back after the particular period over there. Is that clear? That is the repo rate. And what is the bank rate? Bank rate is related to when the bills are to be discounted. It is basically the rate below which the banks cannot be lending. But let me tell you, it's not used for that particular purpose right now. It is used for two particular purposes. One is for rediscounting. One is for rediscounting of the bills, and the other one it is related to charging the penal interest if there is shortfall, if there is a shortfall in maintenance of the SLR or CRR. Okay, so these are the two main purposes which are now right now served by the bank rate over there. And cash reserve ratio, this is a fixed percentage of the NDTL, a fixed percentage of net demand time liabilities of the bank, which are to be maintained with the Reserve Bank of India in form of cash. That is a cash reserve ratio. Definitely, cash reserve ratio is a main point over here, which directly impacts the funds available with the bank. Because if the cash reserve ratio is increased, let us take the case that previously it was 3% and now it is 4%. In that case, the banks are to maintain 4% of the net demand time liabilities in the Reserve Bank of India itself. It directly impacted the amount of funds which were available. Okay, so option C over here will be right answer. Let me mark the question. Option 3 is the right answer in this particular case. Now let's move to the next question over here. It says the rate of discount which is used by the Reserve Bank of India for rediscounting of commercial instruments from bank is represented by, I already just told you that it is a bank rate at which the rediscounting of bill is being done. Okay, and for the repo rate I just already told you, and then it is a marginal standing facility. It is a MSF, that is a marginal standing facility. So MSF is basically a short-term liquidity facility which is provided by the Reserve Bank of India to the banks over there based upon the securities, and it's a fixed component related to the securities which can be basically lent by the Reserve Bank of India to the banks over there. And for the bank rate I already told you, and then it is a reverse repo rate, that is a reverse situation in case of the repo rate. In repo rate, the banks which were having the surplus of the securities were placing their securities with the Reserve Bank of India and were getting the liquidity. Over here, if RBI will be having the surplus securities, not having the surplus securities, actually it's a tool by which Reserve Bank of India just places their securities with the banks. Let us take the case bank X is over there, and further banks are to give the liquidity to the Reserve Bank of India. They will be placing the surplus deposits with the Reserve Bank of India, and after some particular date or in some particular period at a particular price, the Reserve Bank of India will be repurchasing those securities. Okay, so that is the case of the reverse repo rate. So answer over here is option C, that is bank rate. So bank rate over here is the right answer, question number 2. Now let's move to the next question. It's related to which of the following is used in purpose of neutralizing the effect of liquidity generated by foreign exchange flow. So what actually happens in our economy? Let's say that this circle is representing this economy, our economy, and further if there is inflow of the funds or outflow of the funds, that is going to basically impact the economy itself. Okay, so let us take the case that 1 lakh crores were basically liquidated into the economy, or 1 lakh crore amount was basically there was outflow of the funds out of the economy. In that case, that is going to be basically impact the economy itself, and that is basically make the economy more volatile, and that is to be dealt with by the Reserve Bank of India. Okay, so in case of statutory liquidity ratio, what happens? The banks are to maintain either in the form of cash, or in the form of gold, or in the form of the unencumbered securities with the Reserve Bank of India, a fixed percentage of the NDTL. Okay, a fixed percentage of the NDTL is to be maintained with the Reserve Bank of India in the form of cash, gold, and unencumbered approved securities over there. Under the market stabilization scheme, the Reserve Bank of India will be selling or buying the MSS bond. The Reserve Bank of India will be selling or buying the MSS bonds. Now, what does it indicate? So, if Reserve Bank of India purchases the bonds from the market, if Reserve Bank of India purchases the bonds in the market, Reserve Bank of India is infusing the liquidity into the market itself. Are you getting this particular point? Because when I'm purchasing, I'll be paying them the amount. So I'm basically infusing the liquidity. And when the Reserve Bank of India is selling, the MSS bonds, in that particular case, Reserve Bank of India is basically infusing the liquidity in the economy itself. Okay, so that is the main thing that was asked over here, so as to neutralize the effect of the liquidity generated. So if there is excess of the liquidity or excess of the cash inflow from the foreign resources, in that case the Reserve Bank of India will be doing what? Reserve Bank of India will start issuing the MSS bonds. Okay, so that is the case over there. Further, it is a cash reserve ratio, I just already told you, and further then reverse repo and repo rate that you are already aware of. So right answer over here will be option B, that is a market stabilization scheme. Okay, now let's move further with the next question. It says, which of the following ensures the solvency of the commercial bank? Now, what do you mean by solvency? So see one thing, that the public do place their deposits with the banks over there, and based upon these deposits, banks do lend the money and further do invest the money in the different sectors over there. That is the case. Now, there is a risk associated with it. And for that particular purpose, you must be having a buffer, you must be having some capital spare with you, so as in the stress conditions also you can do basically manage your obligations. That is the case. So in that particular purpose, I already told you that a fixed percentage of the NDTL, that is a net demand time liabilities, is to be maintained within India by the banks in case of the SLR in form of cash, gold and approved government securities. Under the market stabilization, what was there? It was related to issuing of the MSS bonds only, nothing related with the solvency part. For the cash reserve ratio, over here also a fixed component of the NDTL is to be maintained with the Reserve Bank of India in the form of cash. In case of repo and reverse repo transactions, this is also not related to the solvency. Okay, so the two components 1 and 3 are related to maintenance of the solvency of the commercial banks over there. But the contribution, because from the question point of view, if there was an option related to 1 and 3 both, in that case we must have selected that. But in contribution, if we look at the contribution by the CRR component is quite lower, it's quite lower, so we'll not be considering it answer, and we'll be considering the fair answer to be option 1, that is a statutory liquidity ratio. Okay, so SLR is a main component by which the banks do maintain extra funds, extra securities with them, which are basically HQLAs, high quality liquidity assets over there, by which banks do ensure the solvency. Option 1 over here is the right answer, and with this case study ends. It says the source of raw material used by ABC Limited as a single supplier. So there is a single supplier for the ABC Limited who supplies the raw material against the letter of credit issued by the bank over there, and some of the details related to this is provided over here. It states that it takes roughly 5 days to get the letter of credit issue. So over here we can say that the issuance time period is basically 5 days, and after that it is given to be that advise it to the beneficiary through the advising bank, so it takes 5 days. And for the on receipt of the letter of credit, the raw material is shipped. As we know that when the letter of credit is basically advised to the beneficiary over there, and beneficiary basically looks into the letter of credit that each and everything terms and conditions is as per the main contract, in that case he will be shipping the goods over there, and the transit time is given to be 25 days. Now the transit time is basically not related to the shipping time period that when the goods will be reaching to the customer over there. It's related to the time period that when the documents have been negotiated till the nostro account of the bank is credited. That is a NTP period that is given to be what? So normal transit period is given to be 25 days. And further it is mentioned credit period allowed by the supplier is 5 months. That is a usance LC is there, and the credit period so allowed, that is a usance period, is given to be 5 months over there. So what does it indicate? It indicates that the letter of credit will be opened at least for the 6 months period, even if there is no overdue. Is that clear? Total raw material consumed in around 1 year, it is given to be 12 crore. So overall consumption in 1 year, it is 12 crore. Taking into account the various factors, the economic order quantity EOQ is given to be 2 crore over there. It is given to be EOQ over there, and that is a size of one order is rupees 2 crore over here. Size of one order is rupees 2 crore. That is EOQ, economic order of quantity, because you are basically importing the goods overseas. Now, in that case, it will be basically expenses will be there. So economic quantity that will be ordering, at minimum quantity that will be ordering, it is rupees 2 crore over there. Okay, so now we need to answer the questions over here. So it says, what is the frequency of the opening of letter of credit? What is the frequency of the opening of the letter of credit? So the total raw material required in 1 year, it is 12 crore rupees, and further each LC minimally it will be opened for rupees 2 crore. So the number of LCs will be there. There will be 6 LCs which will be opened in a year. There will be 6 LCs which will be opened in a year. Okay, and what will be the frequency? For every 2 months, the LC will be opened. For every 2 months, the LC will be opened. So that will be the frequency of the letter of credit. Next question, it says, what is the number of letter of credit that will remain outstanding at given point of time? Now, I just already told you that after every 2 months, the LC will be opened, and further, it is a case that for 6 months at least the one LC will be opened. So how many LCs will be outstanding at particular one time? It will be 6 divided by 2. That is a time period of 1 LC divided by frequency of LC. That is equal to 3 LCs will be outstanding. So minimum 3 LCs will be outstanding at any instance over there. Is that clear? And further, related to the next question, what is the amount of the limit that is to be sanctioned to meet up the requirement as above? So now I told you that 3 LCs will be outstanding at any time, and the EOQ is what? EOQ is 2 crore over there. So that is the limit that is to be sanctioned, because over there 3 LCs will be outstanding at each and every instance over there, and EOQ is 2 crore. So the total limit that is to be sanctioned, it is 6 crore rupees. Okay, so that would be all related to this particular case study over here. That diagram depicts the different stages of the business, different phases of the business cycles over there, and there are 4 phases. One, it is related to boom. That is first point over here. Second, it is related to the recession. Third, it is a depression. That is a worst scenario of the recession. Fourth, it is related to the recovery, when again the economy gears up and we further move towards a boom itself. So what does it indicate? It indicates that it's a periodic, basically business cycle is what? Business cycle is periodic itself. Okay, so it will be repeating it again and again over there. Amplitudes may be different. Likewise over here in boom, we are having amplitude somewhat at a point above than the boom over here. Okay, so amplitudes may be different. Okay, but the time phases may be different, but it is particularly periodic. It is periodic. Okay, so now let's solve the questions over here. It says a downward tendency in the demand is observed, that your demand is now lowered, which is not noticed by the producers. So previously they were basically producing more and they continue to produce more. They have not just lowered their production. That will basically lead to what? That will lead to that the market will be bombarded. There will be oversupply in the market. So previously the market was demanding 100 pieces and you were supplying 90 only. Okay, so the demand was 100 and you were supplying 90. So in that case particularly, you are at boom stage. You are trying to basically produce more and more. But at particular time, the demand will reduce. Let us take the case now. The demand is 80, but you're still producing 90. Now the demand is 60. You're still producing 90. That will basically, the stocks will be piled up. The stocks will be piled up. Okay, so that is the situation over here. And further, which is not noticed by the producers, and further they keep on producing, which leads to a situation of the supply more than demand, and supply is now more than demand over there. The stocks get piled up. Future investments plan are given up, because future investment plans are made only and only out of the profits that will be making, but you're not able to make up the profits now because you're not able to sell your stocks. Okay, workers are retrenched. There is unemployment that will lead to fall in income. So when there will be unemployment, there will be fall in income over there. In demand, demand will be low, because previously my income was rupees 100, but now my income is low. Definitely my demand will also reduce in prices, and also business activity, each and everything is basically lowered. So this is a feature of what phase? This is a feature of the recession phase. This is the feature of the recession phase over there. Okay, so this is the recession phase. Now let's move to the next question over here. It says the slope represented by number 4 in the diagram represents which of the following phases? That is related to the recovery phase. So when you are in depression phase, that is not going to be there for indefinite time period, and that is going to be recovered. That is going to be recovered, and you will be in the recovery stage, recovery phase over here. So that is the answer. Third question over here, it says, in which phase of the business cycle the prices are at the lowest, due to which the consumers that had postponed their consumption start fresh consumption. Banks are accumulated with the cash balances come forwards to give loan at the lower interest rate. With increase in the demand, the piled up stocks start reducing, becomes insufficient, the economic activity and investments start picking up. So that is related to the recovery phase itself, where the prices are at the lowest, because when there is depression there is almost negligible demand. So there is almost negligible demand. So when the demand is at the lower side, in that case there is what, there is basically surplus stocks there are, and for the consumers who have basically delayed their demand now will be purchasing at the lowest prices, and still, and for the stocks which were piled up, they will just basically, the pile of stock will start reducing and further will become insufficient. The economic activity will still will once again it will kickstart. Okay, so that is related to the recovery phase itself. Okay, now let's move to the next question. It says, which phase is also known as the crisis? So recession is also known as the crisis phase. Okay,